Most people believe that getting rich requires excitement. Fast trades, hot stock tips, crypto moonshots, constant action. Because if something is boring, it probably isn't powerful, right? But here's the strange contradiction. The people who quietly build the most durable wealth often live inside an investing strategy so uneventful it almost feels disappointing. No adrenaline, no dramatic wins, no constant activity. Just patience, consistency, and long stretches where almost nothing seems to happen. And yet over time, those same boring investors end up miles ahead of the people chasing excitement. So the real question isn't how to find exciting investments. The real question is this: why does boring investing make people rich, while exciting investing quietly makes many people poor? And there's one psychological shift behind this that most people never notice. We'll come back to that, because the truth is the biggest obstacle to long-term wealth isn't a lack of opportunity. It's human nature. Hey, I'm Joshua, and this channel is about one thing: understanding how money responds to human behavior. We talk about the psychology behind saving, investing, and building income slowly, especially the kind that rewards patience over time. No hype, no shortcuts, just clear thinking and better financial habits. And if this way of thinking about money resonates with you, consider subscribing, because here we focus on the habits and mindset that help money grow quietly over time. Now, let me explain today's topic: why boring investing makes people rich. First, think about how most people approach money. When markets are rising, excitement spreads quickly. You see social media fills with screenshots of gains. Friends start talking about easy money. Suddenly investing feels like a game everyone should be winning. And when that happens, something subtle changes in our mindset. Investing stops being about building wealth. It becomes about feeling smart. We want the story. I bought this stock early. I caught the breakout. I doubled my money in 6 months. There's a psychological reward in being right quickly. But wealth rarely rewards speed. Wealth rewards endurance. And endurance is usually boring. Consider two investors. One is constantly searching for the next opportunity. They watch markets daily. They read endless predictions. They move money frequently. Some trades work, some don't. But activity always feels productive. The second investor does something far less exciting. They buy high-quality assets. They reinvest dividends. They add money regularly. And then they mostly leave it alone. From the outside, it almost looks like they're doing nothing. But under the surface, something powerful is happening: compounding. And compounding has a strange personality. It's incredibly quiet in the beginning. In the early years of investing, progress feels painfully slow. You contribute money. Markets move a little. Dividends arrive, but they're small. Sometimes you check your portfolio and think, that's it. This is where most people lose patience. Because our brains are wired to expect visible progress. We like quick feedback. Fitness shows results. Work produces income. Effort leads to reward. But investing often delays that reward for years, which creates a psychological gap. And inside that gap, boredom creeps in. Here's a thought experiment. Imagine planting a tree. During the first few years, you water it regularly. You protect it from storms. You care for it. But above ground, growth is slow. It doesn't look impressive. Some people would lose patience and plant something else. But underground, the root system is expanding quietly. And once those roots are strong enough, the growth above ground accelerates. Investing works almost the same way. The early stage is dominated by discipline, not visible results. Which is why boring investors win. They stay long enough for the roots to develop. Now compare that to exciting investing. Exciting investing usually involves constant decision-making. Should you buy now? Should you sell? Did you miss the move? Is something better out there? Every decision introduces a new variable, and every variable increases the chance of mistakes. Not necessarily because people are unintelligent, but because markets interact with human psychology in very specific ways. Fear makes us sell too early. Greed makes us buy too late. Overconfidence makes us take risks we barely understand. And constant action multiplies those emotional moments, which leads to a strange outcome. The more exciting investing becomes, the more fragile the results often are. There's another reason boring investing works so well. It removes the need to be right all the time. Imagine an investor who owns a diversified portfolio of strong companies that consistently generate profits and pay dividends. Some companies will perform better than others. Some years will be rough. But the system keeps working. Dividends continue to arrive. Those dividends buy more shares. More shares produce more dividends. The machine slowly feeds itself. This is one of the most underappreciated dynamics in investing. Income-producing assets create momentum. Not emotional momentum, financial momentum. And once that momentum builds, it becomes surprisingly powerful. Think about someone who owns shares in companies that pay reliable dividends. At first, those dividends might cover a small monthly expense. Maybe a streaming subscription. Not life-changing, but the dividends are reinvested. Years pass. Now the income covers a phone bill. Later, maybe groceries. Eventually, those same dividends start covering larger pieces of life. And something interesting happens psychologically. Your relationship with money changes. Because the money isn't coming only from work anymore. It's coming from ownership. Ownership of businesses that continue producing value whether you're paying attention or not. That shift from labor income to ownership income is where boring investing becomes quietly transformative. Let's pause for a moment. When you think about wealth, what image comes to mind? Is it dramatic success? Huge gains? Big financial wins? Or is it something quieter? Consistency, stability, patience. Because real wealth tends to look less like a highlight reel and more like a long, steady process. Another hidden advantage of boring investing is simplicity. Complex strategies often feel smarter. They look sophisticated, but complexity increases the chance of interference. More rules, more decisions, more opportunities to overreact. Simple strategies are easier to stick with. And sticking with a strategy is far more important than designing a perfect one. Many investors fail not because their strategy was bad, but because they abandoned it halfway through. They got bored. They chased something new. They tried to speed up the timeline, which ironically resets the compounding process again and again. Boring investors rarely fall into this trap. Their strategy doesn't depend on excitement. It depends on consistency. There's also a deeper identity shift involved. Some people view investing as entertainment. Others view it as infrastructure. Entertainment requires stimulation. Infrastructure just needs to function. Think about electricity in your home. You don't need it to be exciting. You just need it to work reliably every day. Wealth building works best when it becomes infrastructure in your life. Automated contributions, long-term ownership, reinvested dividends, systems running quietly in the background. When money management becomes infrastructure instead of entertainment, financial progress becomes far more predictable. Of course, none of this feels dramatic in the moment. You won't wake up one day and suddenly feel rich. The process is too gradual for that. But something subtle starts happening over time. The gap between people who stayed consistent and people who constantly change direction begins to widen. At first the difference is small, then noticeable, then enormous. Not because one group found magical investments, but because one group stayed long enough for compounding to fully express itself. This is why some of the wealthiest long-term investors often describe their strategy with almost disappointing simplicity. Buy good assets, reinvest income, stay invested, repeat for decades. No constant drama. No need to outsmart the market every month. Just a quiet system that benefits from time. And time in finance is incredibly powerful, but only for people who can tolerate boredom. So the next time investing feels slow or uneventful or even a little dull, that might actually be a good sign. It means you're not depending on luck. You're depending on a process. A process built on patience, ownership, and compounding. The kind of process that doesn't look impressive in the short term, but becomes very hard to stop in the long term. Because in the world of wealth building, excitement is often the enemy. and boredom is frequently the strategy. If this way of thinking about money resonates with you, if you're more interested in understanding the psychology behind wealth rather than chasing financial hype, this channel explores those ideas deeply. Quiet habits, long-term thinking, and the mental models that shape financial outcomes over decades. Because sometimes the most powerful financial advantage isn't intelligence. It's patience. And patience tends to look boring, right up until the moment it becomes wealth.